This is eSec Lending Insights. Let's get over to our episode. How are we all feeling today? Are we all a little orange? Orange, we glad we're together?
Don't do that. No. Nobody smile.
Are we
Hold the
going yet or
line.
no? Was that real?
Do not encourage.
I think that was real.
Not funny. Dad jokes from Brooke.
We're back, friends. Mark, Mike, Brooke, Jim.
We're
All right.
back. I'm miserable today. I told you. Don't say it, Brooksy. I don't want to hear it.
I would say it does feel like a Monday. I'm with you.
Happy Monday, Jim. I'm
Don't
glad you're
see.
with us.
I hate that. I hate Happy Monday. Don't do that. There's no
But
such
do you
thing.
are there other days of the week where you appreciate a happy Tuesday, happy Wednesday, happy Thursday, happy Friday?
The latter. Happy Friday. That's
Happy
it.
Friday?
I think that's the only one that's appropriate. Well, yes,
Okay.
exactly. That's my take.
Okay. And so on the other days of the work week, the greeting should just be, hey, Jim.
Yeah. Good morning.
Morning.
Good morning.
Yep.
Good morning. Okay.
Hump Day had a good run when there was that commercial that was on TV all the
I
time.
did like Hump Day.
Yeah.
But
Nice little run there. So
I watch it every once in a while just to get a kick out of it. It's really funny going through the office.
I don't know what you're talking about.
Mark's younger than you, and he knows what I'm talking about.
the
That was
only
Hump
like-
Day commercial with the camel, right?
That wasn't that long ago.
No.
Oh, thank you.
Yeah.
Hump Day.
Brooke had probably already moved off of cable to YouTube.
I was going to say,
Yeah.
I stopped watching commercials like 2 decades ago.
You don't watch commercials during the Super Bowl?
That's probably the only event that I watch commercials. So CNBC this morning, the repo markets were featured and the stress in the repo markets. Mike Brooks, what do you have to say about that? You've obviously been talking about that a fair amount yourself. Do you think that's worthy of CNBC time at this point, or is there anything particularly acute or unusual going on? Or maybe you can give our listeners a recap on your opinion and analysis of their coverage.
Yeah, I mean, I think of kind of the environment we were in post-COVID, pretty accommodative monetary policy dynamics, a lot of cash in the markets, balance sheets were big, all technical factors that mean friendly repo rates. Since then, it's been a steady upward trend to normalize the Fed balance sheet. So what that means is rolling off securities in the form of quantitative tightening would be the acronym that a lot of people use, letting securities roll off, pulling reserves from the system and adding collateral back to it. And that's been happening in the background for a couple of years now, and that tends to firm up repo rates. We haven't seen it from a material standpoint because there was still so much cash in the front end. Looking at the money that's parked at the Fed in the form of the Fed's reverse repo facility, that was always a couple trillion for a long time and then multi-billions for years at a time. You're starting to see now basically that excess signifies excess reserves in the system. That is now fully drained. It's a couple billion, singular billion, which sounds like a big number in the landscape of the repo market. It's basically nothing. A lot of chatters around the excess and abundance of reserves is now starting to flip to people talking more about reserve scarcity as the Fed and then in tandem dealers are trying to normalize their balance sheets. The bill market and the treasury market coupons continue to see an increase in supply, especially after the more recent debt ceiling resolution, which allows the treasury to increase the deficit, increase borrowing again. That tends to get done through the issuance of new debt, right? So you're seeing more collateral hit the market. Dealers' inventories are continuing to get bloated, so they have to finance more or they have to sell them in the cash markets. A lot of chatters around who are the true cash buyers of treasuries and some of the international guys that are stepping away. You're hearing a lot of Asian participants stepping away. So maybe there's not as many cash buyers of treasuries as well. So kind of all factors, a lot of them technical, that are making repo rates higher than where we were this time last year. Fourth quarter is also a time of year where you start to see repo levels move up because balance sheets tend to get tight. Not many guys are looking to bid in collateral. That repo is a balance sheet intensive product. People have to hold capital against it. So that's also pretty wary as well. For the first time in a while, it feels like it's getting back on the radar of Fed officials. It was referenced last month at the Fed's FOMC meeting that quantitative tightening is going to stop December 1st. In theory, pulling reserves out of the market on a monthly basis in the treasury front will now stop. MBS will be rolled off in the form of I let that come off the sheet, and then you'll layer into that. We rolled into more T-bill purchases. So targeting the front end of the market is another technical factor that could increase liquidity. You've heard a lot about the acronym of the standing repo facility the last couple of weeks to months. That is where the primary dealers have access to it. They can sell their collateral to the Fed at a fixed rate, and the Fed will lend cash to the market. The Fed is now tapping all their primary dealers, saying, we want you guys to test this facility, better help banks intermediate the market. There tends to be a stigma on using that facility. The thinking around that is basically, well, if they can't finance their longs through other market participants, they have to use the Fed as a last resort. Like, that is seen as a negative. I think the Fed's trying to kind of squash that stigma and want people to use it appropriately, because if it's used in good size, not just to test, and used as it should be, that should help alleviate some markets. So I do think that's part of the CNBC story getting more headline attention, is as we're moving closer to year end, which is the most important reporting date, I think they want their primary dealers to use this facility in good size, help the market eliminate some of the stresses we're seeing in funding. They have acknowledged that repo markets should be volatile around this time of year. You should see gaps up on reporting dates, on dates where supply comes in. That's all normal. I think getting back down to more normalized levels after that happens is what they're trying to accommodate. You do want smooth functioning in the repo markets, because it's the underlying mechanism and plumbing for treasury markets as a whole, and you do want confidence in that market. So, a lot of boring fixed income gibberish just thrown your way, but it is starting to be talked about a lot more. And I do think it's going to be important, not just for our markets, it's important for our book, because we are lending a lot of treasuries and requiring funding markets and dealers to take those treasuries on sheet with appropriate bids. But there's also a lot of linkages to the repo market as well in other asset classes. So there's a lot of contagion effects that can occur if the repo markets are elevated as well.
Right. So if you had to guess, and I know you're obviously making an educated guess here, but you think that maybe the reason why it might have been highlighted on CNBC today was perhaps because the Fed's pushing a narrative where they want more usage of the facility and normalize that usage. And that's maybe why it's having a broader reach.
I think that's part of it. I do think December 1st is coming up as well, where QT will in theory end, and then we'll have the December 10th meeting to see if some of these more temporary measures, which is letting QT come off or using the standard repo facility, maybe don't have the intended consequences of funding market normalization. There's a few other type of overnight market operations. There's some other things the Fed can do to help markets and provide the necessary plumbing. I think maybe that's something they want to push back on a little bit and maybe don't want to use. But I think just having every lever out there potentially in the market is getting more attention now than it did maybe a couple months back.
And Mike, it seems like that stigma's existed for a while, and there's always this notion like, hey, maybe it doesn't make sense for there to be a stigma associated with this, right? But I can remember a similar narrative that seems to pop up every few years. And despite the idea or an effort to remove that stigma and normalize the use of the Fed facility, it seems to always be here. So besides the headline, do you think there's going to be any real change in behavior?
Yeah, I mean, the stigma kind of goes back to earlier days of the discount window, which has been used for years and then went unused for many years. I think right now it's not as much of a stigma of tapping the facility, but there's also some operational hurdles around the timing of the facility and the netting and clearing of the trades that people have top of mind. But I think we'll start seeing it tapped more and more. I think you already saw that the last couple of weeks. Typically, you'd see there's a morning operation and an afternoon operation. The thinking is repo starts getting hit in the morning, starts going higher. The operation between 8 and 8:30 comes and kind of eliminates some of that pressure in the market that the afternoon operation wouldn't need to be tapped as much. And you have seen that narrative, that trend's been happening. It happens around reporting dates on the end of the months, the 15th, when settlements come in. Recently, it's been getting used on normal Tuesdays, normal Wednesdays, on days where you wouldn't expect that to be utilized. So I think that's why it's getting some attention. It's tough to tell whether some of that is just the dealers are taking the tap on the shoulder and they're testing the facility and they're using the facility like asked, or if they're finding it to be a need of really funding their longs. That minimum level, that fixed level, I do think markets need to trade a decent amount above that for dealers to use it in good usage and for them to make sense from like an arbitrage opportunity of that trade. So when you come in the morning, you're only a couple bips above that level. I don't think you're going to see good usage, but over month ends and particularly year end, I think everybody wants everyone to be fully on board with using it over year end because, kind of looking at forward markets, I do think it's going to get a little bit bumpy as well. And I think you kind of saw that as a preface was the Canadian year end, which got more attention in repo markets than maybe some would have expected or maybe that it has in the past.
Yeah, I think we're spending a ton of time talking about overnight markets and where levels should be and how maybe it will be mitigated. But the other half of the equation is secured funding, right? Just because overnight the Fed facilities use a bit more, secured funding is still going to be scarce. And that's going to pull on overnight rates a bit too. There's not really going to be any end in sight for the need for secured funding between now and the end of the year.
I agree with that. I mean, secured funding in multiple asset class in the treasury fund, as you're seeing just treasury issuance increase, you're going to see secured treasury funding increase. You're seeing equity valuations. I know take away the blips of the last week or so, but valuations remain very high. Index futures remain high. And so the funding on that collateral is going to be increased. You're seeing increased issuance in the fixed income space, whether it's corporate bonds or CLO markets as borrowers or dealers onboard new clients that have longs in those asset classes, they're going to need funding there as well. So I do think in general, you're going to see secured funding just increase.
So, Mike, where's the opportunity been for us? What's something that we've been working on?
Yeah, I think we talk about it a lot. We talk about increasing collateral schedules, both cash and non-cash. If you can be a partner with the borrowers and counterparts as they see their book shift, if you can work with them there, I think you have in a sense, first mover advantage. We talked a lot about CLO issuance increases. Borrowers are trying to get involved on both sides of that trade. They want to buy the CLOs and they want to sell the CLOs all in secured funding markets. It's no surprise the matchbook on those trades have wider spreads than they do in typical treasuries. So it's a more lucrative trade, a more lucrative use of balance sheet compared to some other trades. So we've definitely had some clients who want to be on both sides of those trades, want to use their CLO longs to fund different strategies and also have cash to go and want to take advantage of the yield pickup. So spending a lot of time there. Equity secured funding is always something we talk about. I don't think that's going away. We mentioned the valuations, year-end basis in swap trading. Those dynamics will be there for the next couple of months. You mentioned a lot about the ETF dynamic, about there's more ETFs now than single stock names. Clients that could add ETFs as a part of an equity schedule will definitely have more stable supply, or just trades that can be specific, just ETF baskets in general. We're starting to see counterparts and borrowers wanting to pledge. So we're working with clients and we're working with our insurers and our schedules as well to help accommodate some of those trades. So I think that's going to hopefully sneak in before year end, but I don't think just because, year end ends Jan 1, 2026, that stuff goes away. I think that's going to be a strategy and probably a theme for a while.
So Jim, you haven't said anything other than being the kid in the classroom that's sort of like throwing spitballs.
Wouldn't
against
throw a
person?
spitball, you would shoot it through a straw in my school. Anyway,
I've never been a participant in that. So
shocker.
maybe I should use an analogy that I'm familiar with.
Yes, let's use an analogy you're familiar with.
I'm not typically very annoying, so
You're not? Oh,
you seem like you have something you want to say, but haven't yet shared. That's what I want to get at.
I was curious if the year-end funding has seeped into Mark's world. And I know you have a lot of these trades on where you lend, take cash, and you do repo against it. Does the tight year-end have any impact on those trades or your ability to do new trades, rolling off old trades? What's the ripple effect that you're seeing from the tighter funding year-end?
Yeah, so I think new cash raises that are part of some funding wrapper has probably been one of the more advantageous trades or opportunities the past month or so, going back to August when people started to focus on the end of Q3. In instances where you can raise cash with someone, then spend the money with them in repo, we're seeing both opportunities to scale existing trades, raise money for new trades, and we're seeing a broadening of the axes from a maturity perspective. I think when we first started focusing on some of these trades a couple years ago, there was a lot of money being spent in the 3-month space. Now we have counterparties looking for 7-day, 35-day, and maybe 95-day funding. For Mike and I, it allows us to ladder some of that spending out throughout portfolios and maybe hit some of the key buckets so we can scale a bit more. Some clients might be able to do a bit more in the 35 and in space than others. I think it's opened up new opportunities for those clients. It's been a good opportunity set for us and one we've worked very closely with our counterparties on. It takes a bit of coordination, but It's something that Mike and I are well versed in at this point.
I might have asked the question wrong. What I'm really asking is there ever a scenario where there's a spread through the middle between when you trade that, the cost of funds, lending the equities or bonds and cost of funds, and then spending it in repo? Is there ever a scenario where that spread widens out, or does it remain the same? And so you get a higher level, maybe elevated levels on the repo side. Do you have elevated levels on the cost of funds side, such that the spread remains the same?
Yeah,
That's
we
really
see spreads have definitely widened at the margins. So we're raising cash around the same levels and we're spending it slightly better.
okay.
I think if you take the complete opposite side of it, or I guess slightly different, like outright cash raises is where we've seen an impact on the cost of funds, right? So if you want to raise cash from a counterparty, it's going to be more expensive than it was 6 months ago. Even this time last year, it seems. Cash collateral is being monetized, no secret. So, it's definitely a bit more expensive to raise cash if it's just an outright spend where it's not under one of those funding wrappers. In capacity there, not only is it more expensive, there's a change in capacity. So that is a different challenge too, besides the cost.
So we're past mid-November. We have a few more weeks of November left and then the month of December until we get over the turn. We'll, I'm sure, do a year in review wrap at some point and talk about how the year went. But in terms of what you think is going to happen between now and the end of the year, are there any notable trades, Mark, that you would highlight, or Mike, other comments that you would make outside of just normal funding pressures that you've reviewed that you think would be worthy of highlighting, or predictions that you have for the next 6 or so trading weeks?
On my side, we're keeping an eye on the Fed because running the reinvestment books, there's a component of embedded duration you use and as part of portfolio management analysis. And up until really recently, I think the market was gearing for a more dovish tone and pricing in multiple cuts. So you saw a lot of PMs start to layer in duration, increasing both the WAM and the WOWs of their portfolios because they wanted to be positioned well for books hanging in right after cuts. The government shutdown threw, I think, a little bit of a wrench in some of this, really from the lack of data and information because of the shutdown. Employment data, inflation data, both private and public sectors, consumer sentiment, all things that you tend to get on a frequent basis, which is already on a lag by the way that statistical management works. Now it's even more so. Last week's reopening, I guess, of the government is making things interesting because they have a couple of weeks now to try to get a handle on the up-to-date information and then make a decision in December on what they want to do. There's continued back and forth against weakening jobs markets, weakening consumer sentiment, against sticky to higher inflation. And there's a lot of people in various camps that think they should stay on pace with the cutting narrative, or we don't have to rush things. The market is not as strong as we'd like, and we can keep things on hold and see how things shake out in Q1. Obviously, the equity markets have been reacting aggressively to that. For us, we're putting a lot of focus on that for positioning aspects. I do think the base case is still they're going to cut in a couple of weeks here. Although the conviction around that sentiment is maybe decreasing by the day. I do think there's a lot of information we still need the next 3 weeks or so, but I think there's going to be a quick turnaround from, all right, get the Fed decision, get the forward guidance on rates, see how the Fed officials and voting members feel about the path of interest rates. Then you'll have a small 2-week window where you start to prepare for actual year end and flows and higher levels and all that stuff. So it's going to be a lot of different dynamics happening in a 3-week period that impacts clients in various ways. So I think that's where we'll be, maybe not really a trade idea, but more of themes that we'll be paying attention to. You'll probably hear us harp on a lot.
Okay. All right. Well, it sounds like you're in a fast sprint to the end of the year trying to figure out what's going on there then. Good luck. Mark, anything worthy of highlighting?
Yeah, so LEN has an exchange offer. The expiration's been pushed a couple times. It was impacted by the government shutdown, so it's due to expire the 21st this week. So for S&P 500 holders on those portfolios, it could be a nice little pickup there. Could be a name that even pops into the top earners for some beneficial owners. Pricing is only at 15 cents, but because it's a large cap stock, I think some clients will be able to participate in pretty good size here. So that's definitely one thing to put on everyone's radar. Close to the end, one definitely to inquire with your lending agent to make sure you're participating. ETFs, we're getting to part of the year where there's a lot of seasonality and ETFs tend to perform well. So main index ETFs like SPY will see some higher utilizations, SPY, IWM, etc. But then even more interesting, so we have a number of ETFs that are amongst the top part of borrows right now. So ARK is one, ARKK. It's been pretty persistent around the 5% to 15% fee now for a couple months. It's a top 5 US equity hard to borrow. So it's not too often we see something of that scale that's an ETF up at the top of that list. ASHR, which tracks Chinese equities, has been a top part to borrow too. And then some of those levered ETFs that we've talked about in the past, we're seeing persistent demand for those with maybe a bit of market volatility, hedging, things like that. It's a product that's definitely worth monitoring. I think some of these names will be the top performers for the quarter. That's a pretty safe assumption. So didn't really go out on a limb there. So maybe I should say more ETFs will be some of the top performers for the quarter. We have about 5 in the top 25 names right now.
Save the predictions for a separate podcast. How's that?
Yeah.
We're
Well,
gonna do.
I was just asked to make one. So
No, I know. I'm trying to save you, Mark.
thank you.
Because we're doing our best here. But we'll do a year-end wrap where we kind of talk about what worked, what didn't this year, and then maybe we talk about actual predictions. Get this crew back together, Brooke, as opposed to just me making wrong predictions.
Okay,
Can have
sounds good. We can do
everybody
that.
make 'em.
I'm happy to take bad predictions from everyone. All right. Well, thank you guys for gathering. Listeners, we're still trying to determine if this color palette is working for us well. So if you do have comments, if you have suggestions, or if you think it looks better on some than others, let us know. We are on YouTube now with this podcast in video form. I'm not sure that this one was worthy of publishing, given that Jim Maroney was not the most well-behaved student for the first quarter of the podcast, maybe even a third of it. But we'll see what magic Holly can do to minimize his distractions with us. And otherwise, thanks everyone. We'll be in touch soon. Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, or liability for, decisions based on such information.